Good morning, everybody, and welcome to our latest webinar, Tax Considerations for Property Developers, with Angela Wood, ETC Taxes MD, and Keith Miller, our Associate VAT Director. Please, if you can have any questions, pop them in the Q&A box. We probably won't have time at the end to go through these questions, but what we will do is we will download them, answer the questions, and send them round along with the recording and the slides. So yes, thank you. Angela, over to you.
Thanks, Sarah. Morning, everybody. So I can just see Keith off camera there. Best to see both of us. Morning, everybody. Yeah. So as Sarah says, we're going to crack on because there's quite a lot to get through today. And Keith and I were talking yesterday, and some of these sort of slides or topics could be a webinar in their own right of an hour in duration. So as Sarah says, you do use a Q&A. We may not have time for questions at all at the end. Sometimes we allow you to come on and ask questions, but as Sarah says, we'll pick those up later on. We'll see how we get on. So let's get cracking today. She says, slides slow to move. Give me a second. This is not a good start technologically, is it? Hold on, bear me a sec. Sorry, there we go. Here we go. We're in business, right? Sorry about that. So first thing then is to think about the choice of trading structure. So this slide really doesn't actually talk about the choice of trading structure at all. I've just included a brief slide on property investment versus property trading and the things we need to consider. I'm not going to labour on this today because I think most people on here will be aware of the distinction between trading and investment, and really it all boils down to the badges of trade, which are on screen there for you all to see. So I'm not going to labour on that point, but suffice it to say that the first thing to think about when we're thinking about property development is whether something is a development or whether it is an investment. And the other thing to mention there is that it's the intention that matters. So I put it's the thought that counts, and I'll come back to that a bit later, but evidence is key really. What was your intention when what was your client's intention when you acquired that property? So again, just briefly on these, because these aren't the important points really, but trading, what might trading look like? So some things that might look like trading: short-term sales at profit, construction, reconstruction and refurbishment to sell, assembling land registers with a view to sell, and again, likely to be repeated activity, but can be trading actually if the activities are carried out just once. So I think quite a lot of the time, one of the badges of trade you'll be aware is the sort of the regularity of the activity, but actually we have seen cases whereby there is still trading business, even though the activity has just been carried out once. And again, a lot of that comes down to the intention and what was set out at the start. If you want me to elaborate on that in the Q&A, I can. Investment then is the opposite, really, retaining properties for the long term, where you want income from rents, capital appreciation, or where you've got premises being used in the trade. So hopefully that distinction is familiar for most people. So we'll move on now. So in terms of the choice of trading structure, there are obviously various options. And again, I don't plan today to go through what it looks like to be a sole trader, a partnership or an LLP. I think most people will be aware of what that means in general terms, both from an accounting and tax point of view. Just really to focus today on the use of a corporate structure, which is likely to be one of the most popular options for property developers. But some of the things that we talk about will apply both in other scenarios and other structures. If you are trading, there are some important reliefs available to you, and those are business asset disposal relief and business property relief, which we'll talk about later on. And in terms of a typical structure, what might that look like? Well, most property developers, and certainly in the past, we'll talk about why that's perhaps an issue at the moment, or it's become an issue, would consider a project-by-project special purpose vehicle for their development. So if they've got, I don't know, a block of 12 flats they're developing, and then they're moving on to a former pub site that they're turning into semi-detached dwellings, they would have each of those projects isolated within a special purpose vehicle, SPV. So what might that look like? Well, SPVs are, as I say, a well-trodden path, and as we know, it's corporate structure, so profits will be subject to corporation tax at 19/25% now on profits in excess of 250,000. And what that means, of course, is that profits can be rolled up within the company and reinvested into the next development. What used to happen, and what still does happen, is that then when you have that special purpose vehicle, at the end of its useful life, so once that project is complete, the company will be wound up. And then you would want your funds from that liquidation to be treated as a capital distribution and potentially to be able to access business asset disposal relief. And obviously that's much more favourable than paying income tax on the profits from that project. So typical structure, I didn't realise this slide was going to drop in like that, but there you go. So typical structure used to look something like this, project by project. So with your SPV A, B and C, with your projects below those, and then say your profits being taxed within those businesses at up to 25% at the moment, and your capital distribution on liquidation at 10% if subject to business asset disposal relief. However, things changed a little bit, so let's move on. So, however, what happened was we had the introduction of capital distribution rules. So, and again, the details on the slide, I'm not going to read out line by line, but suffice it to say that if you fall within these conditions, which a lot of people developing property will do, so if you've got at least 5% interest, it's a closed company, so 5 or fewer shareholders, or has been in the last 2 years, and it's reasonable to assume, and we'll come on to that, but the main purpose of the liquidation is the avoidance or reduction of a charge to income tax. So, are you looking at getting capital capital treatment, which often people are? The practical effect then of the capital distribution rules was that the income or the sum from that project would be treated as income, I should say. So obviously then people would be significantly worse off. So that's what happened with the capital distribution rules. Obviously that was a bit of a blow. So the challenge there is, what if the main purpose of the SPV sort of structure is the isolation of commercial risk in an SPV? As you'll all be aware, there's a good reason often for liquidating SPV on completion of development. So if people are using external funders, they may want a clean company for the next project. Obviously, the developers themselves might want to protect exposure to trading risk. So it's fair to say that avoiding tax may not be the main purpose of the winding up. But the issue is that the law doesn't talk about the main purpose, it talks about one of the main purposes. And that's where it becomes a bit grey. So one of the other problems is clearance, i.e. there is no clearance procedure for this. So, you could try non-statutory clearance, but unfortunately HMRC don't offer a specific advanced clearance procedure for this kind of scenario. And the guidance that they published is not very helpful. So, as I say, there's a risk, I think. Looking back at that structure as was with those SPVs side by side, there is a risk that if challenged by HMRC, it could be seen to be a tax avoidance motive, or one of the main reasons for doing that could be seen to be a tax avoidance motive. So we need to think about alternative options. And one of the options that we can think about is use of a holding company with subsidiary SPVs. So I haven't got a slide for this, perhaps I should have, but it's a simple structure with a holding company above and subsidiary companies below. So what that means is the after-tax profits from each SPV can be paid up to the holdco without any tax charge, and each SPV can then be wound up and a new SPV formed below the holding company for the next project. At the end of at the end of someone's career, at the end of someone's life, if you like, you can then look at winding up the holding company and getting capital distribution treatment in respect of those profits, again subject to business asset disposal relief. So that does work, we believe, and can work quite well. The other option, which is perhaps less attractive, is selling the shares to an unconnected purchaser. So that's to say, to turn the SPV into a cash shell, and rather than liquidate it, sell it to a third party for a price more or less equivalent to the amount of the cash value. We think this is high risk. It is done, and HMRC have actually expressed the view that they don't think it works. So I don't think that's something we'd want to be considering. So I think your best option there is likely to be a holding company structure. And if you have clients that, for whatever reason, are reluctant to bring a holding company in, I say there is an option still to look at these side-by-side SPVs, but just to be mindful of the risk associated with that in terms of the tax avoidance potential motive around that. So again, a couple of reliefs here. Again, a lot of these will be familiar to you, so perhaps nothing, entirely new. So if you are a property developer and you have these structures in place, what reliefs might you be able to avail yourself of? Well, the first one is business asset disposal relief. I don't plan to go through the conditions for that. I indeed talk about the first three bullet points on that slide. But if you fall into any of those criteria, then potentially business asset disposal relief is available to you on disposal of those, or on liquidation of those businesses or projects. The associated disposals point is just worth making a small mention of, and that is to say that if you make a disposal in connection with your withdrawal from a business, then business asset disposal relief may also be due on that disposal of that asset, provided the business itself or the project itself would have qualified for business asset disposal relief. And finally, I've just put a brief note on there about McGregor and Adcock and the line of authorities from those cases. And that is really just a note to say that a business is more than a mere collection of assets. So for the purposes of business asset disposal relief, we must be looking at a trade, professional, or vocation which is conducted on a commercial basis with a view to profit, which obviously hopefully makes sense. And say for most of you, business asset disposal relief be something I'm sure you're quite familiar with, so normal principles apply. Something you're perhaps less slightly familiar with is business property relief, which is a relief for inheritance tax purposes, of course. So similar principles apply as to business asset disposal relief in terms of some of the conditions you have to satisfy. But I guess I wanted to focus on some of the nuances around BPR briefly. So the first question is, what is mainly a qualifying business? So it's a bit unusual this, but wholly or mainly test is not actually an easy test to apply when you're thinking about some business property relief. So what you're looking at is in the context of the property development, what are the main or primary activities that company is conducting, and where are its sources of income or gains at the time of the transfer or liquidation and in the period leading up to that. And I say it's quite hard to lay down any precise ground rules around that. So one of the cases that has discussed this, it's quite an old case from 2004, but is IRC and George. And they say that some things you have to look at in the context of trying to decide whether something is genuinely a trading business and therefore will qualify for business property relief are the context, which we've just talked about. What is that business doing, the profits from that business, the turnover, the amount of time employees spend on certain activities, the history of that business, has there been a change in how that business has been conducted, and the overall impression. So these are all quite vague things, but suffice it to say that there is no BPR available if the business is wholly or mainly one of conducting investments. So clearly property investment would not qualify for business property relief. Property development is and can be borderline, and I think again that's where you need to just take care. But if you are genuinely developing buildings and constructing businesses with a view to profit, then I think you would be okay on the BPR. And the other option and the thing to think about is whether there are single businesses, multiple businesses. And I'm sure many of you have seen this discussed or have discussed it yourself with clients in terms of being able to separate out investment activities from trading activities to ensure that you don't taint the ability to claim business property relief. So you may be able to make an argument that actually, although there is some investment activity as part of what that developer is doing, that actually forms part of a different business. But again, you have to tread very carefully, and we can assist with that, of course, if that is relevant to any of your clients. I've just made a mention there of Brander, Balfour and HMRC, and this is just to say that basically, if there is a tainting effect, then the whole of the business will be disqualified from business property relief. So it's not just the part that's attributable to the investments that will fall outside of that ability to claim BPR. So if there is a tainting effect, BPR will be no longer available. So you do have to tread very carefully on that. So let's talk a bit about transactions in UK land. This has been around, again, I can't quite remember when this was brought in, but this legislation has been around for a good few years now. And basically, although it is also relevant to UK resident persons, it basically removed the advantages of treaty shopping. So it ensures that UK land held for trading purposes is taxed as income. And we've already talked about, obviously, the distinction between investment and trading and income and capital gains. So again, I'm not going to read these conditions, but suffice it to say that if the main purpose of the activity is to realise a profit or gain from disposing of the land, and there are other conditions here, things like held as trading stock, then you will fall within an income tax charge and not a capital gains tax charge. Again, quite a long slide and conscious of time, so I'm not going to read this out. It's just worth noting. You'll get a copy of these slides afterwards, what HMRC have to say on it. And basically what they have to say is a bit circular, really, because at the end here they say, the legislation should always be understood in the context that it is taxing only what are in substance trading profits. So if something is a trading profit, it is a trading profit, and therefore it should be taxed as income. So I'm not sure that's particularly helpful, but that's what they have to say anyway. Just a few examples then of, again, where it becomes a bit more grey. So, you know, you might think, well, why am I mentioning property letting on a property development webinar? But again, if the idea is the investor expects primarily to benefit from capital growth over time, in addition to obtaining rental yield. So the legislation requires that a main purpose of the arrangement is to obtain a gain from disposing of the property. So that's the aim. So if in the case of long-term investment where the economic benefit is also a capital gain, that won't fall within the nature of trading, if that makes sense. I don't know if I've explained that as well as I might. Duality of purpose, again, a case here which I won't refer to, it's on the screen. So if a person buys land with the intention of building on it to retain it for their own purposes, and then building out another part of that for a sale at profit. So there's two bits that, so part of it they may be sort of using as their own residence, and part of it they may be developing with a view to profit. In this instance, you need to look at a just and reasonable apportionment as to income, profits and capital gain, or in this case, if it was main residence, there would be no capital gain. So you're looking at a just and reasonable apportionment according to the land, and there's various ways of doing that. It could be based on square footage or usage, and there are various ways you can do that. And I'll come on to the anti-fragmentation rules later in case anybody's dying to know what those are. Change of intention. So we talked at the start about intention is key, but obviously people can and do change what they plan to do. So in this example, an individual investor has acquired a block of flats and they rent them out. So at the start, the intention was to have a property letting business and rent the flats out. They did that for several years. And they then decided to obtain planning permission to knock those down essentially and build a new development to complete and sell. So at that point, there's been a change of intention. And so only the profit relating to the period after the change of intention will be taxed as a trading profit. So again, there's an apportionment of sorts. So the first part when it was being let, any capital appreciation during that period will not be taxed as income. But the bit after it's been developed will be, and you need to make that apportionment. Sorry, I'm conscious going quite quickly, but say conscious of time, we've got down to key that point. So what does this slide tell us? Well, it tells us what we already know, which is basically that these activities are treated for income tax purposes as profits of a trade. And again, just worth mentioning, if they're non-UK resident people that are developing these properties or conducting these activities, they'll be treated as a trade of dealing in or developing UK lands. So the same principles apply. The reporting is slightly different, which we'll come on to later. And the income will arise in the year in which the profit or gain is realised. So we're going to look now at disposals of property deriving value from land in the UK. So often referred to as the anti-enveloping rule. So what that means is if a person realises a profit or gain from a disposal of a property that derives at least 50% of its value from land in the UK, this will meet the main purpose condition that we talked about earlier. So the main purpose. So the profits related to the UK land will be treated as a trading receipt, which is what we would expect when talking about property development. However, let's look at some examples here. So you may have heard of the concept of property-rich companies, and this is just one example here for you to try to get your head around this 50% test. So I will just talk through these bullet points. So company X owns 100% of company Y. Company Y purchases a piece of UK land and carries out redevelopment of flats. Company Y has no other substantial assets, so meets the over 50% test. And the intention of company X is for company Y to develop the land and to immediately dispose of the shares in company Y, and this is what happens. In this example, the disposal meets the conditions and is a disposal of property deriving its value from land. So the profits should be treated as trading profits of company X. It's quite a funny little nuances, and it can be quite hard to get your head around. There are some other examples which I can provide after this webinar if you like, but again, due to time, I haven't got more time to go into a lot of detail on this. We need to move on to anti-fragmentation rules. So what are they? So where persons or associated parties perhaps act together on a development, and that essentially fragments the profits. Fragmented profits can sometimes be then placed outside the scope of UK income tax and corporation tax. But where these rules apply, the whole amount is taxed on the person making the disposal. So let's look at some examples. There are 3 or 4 examples here. I'm not sure, again, I'll go through all of them, but just keep saying you will get a copy of the slides. So in this example, company X is carrying on a trade of dealing in or developing UK land. It receives admin services from a group company and pays a markup of 2% on the costs. In this instance, the contribution we regard as insignificant and the fragmentation rules would not apply. Okay, that's fairly straightforward, hopefully. Example 2, company Y carries on a trade of dealing in or developing UK land. A group company, company Z, designs all of the buildings for that activity. Company Y pays company Z 10% of the profits to the division of architectural services. In this instance, the profit made by Y would not be regarded as insignificant, 10%, with regards to the side of the project, and the fragmentation rules would apply. So hopefully you can start to see that what the anti-fragmentation rules are designed to do is to stop you separating profits such that some of those would be diverted elsewhere. So in group situations like this, where you are paying for additional services, in this case, architectural services, it's to stop that breaking up of profits, essentially. There are a couple more examples here, but I won't go through those just now. We'll move on to SDLT. So SDLT considerations, when you're looking at property development, huge number of things we could talk about. And again, I haven't got time to go through them all and can provide more details. So I picked on the most common, I suppose. And the first one is the acquisition by a property developer of mixed use property. So again, a lot of this will be quite familiar to some of you, I'm sure. So you may be aware, I'm sure you are, that if you acquire a mixed use property, you can often treat that purchase as a non-residential purchase, meaning you have access to lower rates of SDLT. So significant savings are possible. So the question really is there any non-residential use? I've put here, beware, must be legitimate commercial use, not artificial or contrived. And again, I think there were some examples. There's lots of examples of this on HMRC's website, and you can probably think of your own examples of this. But something like buying a house which has some stables, for example, are the stables commercially let, and have they genuinely been commercially let, or are they just ancillary to the main residence? There are lots of cases online about equestrian centres and stables and things as to determine whether those are commercial or whether are they part of the residential dwelling. And I've put here, what is a dwelling? Well, I've put the legislative reference for what is a dwelling. But something that is suitable for use as a dwelling is in the process of being constructed or adapted for such use, or is a dwelling in its own right already, and it includes the gardens or grounds and land that subsist for the benefit of that. I think there's a garden or grounds, but it should say the house, sorry. So again, I haven't got time, and neither do I think I need to go into the definition of what is a dwelling, but just, you know, if there is some sense that there might be some commercial use or some non-residential use that property has been put to prior to the acquisition by the developer, it's worth checking out, because as I say, there are some significant savings to be made there, but just tread carefully as always. What else might happen? Well, developers might be looking at buying multiple properties. If they do, the acquisition of those properties will almost certainly be what's referred to as a linked transaction for SDLT purposes. Now, what that does is that immediately puts you into higher rates of tax. So essentially where a buyer is buying from a seller, a single seller or seller, and persons connected to that seller, a number of properties in a single transaction or in a series of transactions where they are essentially linked, then you will pay higher rates of SDLT, or the developer will pay higher rates of SDLT. So that's the bad news. But the good news is there are some reliefs available to allow those developers to reduce their SDLT liability. And again, some of these I'm sure you're very familiar with. Multiple dwellings relief, and I put versus 6+ properties. So multiple dwellings relief, where you buy multiple dwellings as part of one transaction. That can be at the moment 2 or more, although there is a consultation at the moment going through with HMRC to one of the proposals for that is that they increase that to 3 dwellings, partly due to trying to combat the idea that people are buying properties with granny flats and claiming MDR, which HMRC don't seem to like anymore. Anyway, sorry, it's a tangent there. But so yeah, MDR applies to acquisitions of multiple dwellings. And again, I'm not going to go into the mechanism of what that does for SDLT, but it allows you to reduce your SDLT liability if you are acquiring multiple dwellings. You've also got the idea that if you acquire 6 properties or more in a single transaction, and this is just a strange part of the SDLT legislation, really, which is in itself a very complex piece of legislation. If you acquire 6 or more properties in a single transaction, residential properties, those can be treated as non-residential, which is odd, and I'm not quite sure I know what the logic is behind that piece of legislation, but that's what the legislation tells us. So sometimes it's a case of trading one off against the other. So MDR versus the 6+ rule. And it's a bit of a number crunching exercise to work out which gives the best result. Gets even more complex when you've also got multiple properties where some of those are mixed use, which is our last slide. And that becomes a real number crunching exercise and will depend on the individual circumstances. Absolutely. So then we've got derelict properties. Again, quite obvious, hopefully, what a derelict property is, although not obvious from an SDLT point of view always. So if a property is in a state of disrepair or abandonment, you may, or the developer may be eligible for SDLT relief. So it says here the property must be in a state of disrepair and must not be, again, suitable for use as a dwelling, which is what the legislation tells us, without undergoing significant reconstruction. It can be very, very tricky. We've dealt with quite a number of cases around derelict properties recently, and HMRC are quite hot on this, although, you know, as they often do, they seem to like to extend the legislation a little bit in their responses. But yeah, it really does need to be in a pretty poor state to constitute a derelict property. So we've had clients come and say, well, you know, there's a kitchen missing from the property, but if the plumbing and the infrastructure is in place for the kitchen, that is unlikely to mean that you can claim relief for that being a derelict property, just as one example there. Quick note on anti-avoidance. Anti-avoidance for stamp duty and land tax is big. Section 75A Finance Act 2003 is the specific provision which applies to bring in these anti-avoidance provisions for SDLT. Sub-sale arrangements have been quite popular with developers in the past, so whereby they enter into contract to acquire a piece of land, but then immediately enter into another contract to sell that on to perhaps another developer. And essentially that land never really becomes theirs, and there is a sub-sale arrangement in place. So in that instance, SDLT is only payable on the second leg, provided certain conditions are met. However, HMRC have got quite nervous about sub-sale arrangements, primarily because they were used as tax avoidance schemes quite regularly over the last 10-15 years, less so recently for reasons outlined on this slide. And one of the cases that discussed that is Project Blue and HMRC. The result of that case was that Section 75A, the anti-avoidance piece of legislation we mentioned, will apply regardless of whether there was a tax avoidance motive. So what this means is whereby in the past, a lot of these sub-sale schemes were clearly designed for tax avoidance, and so were caught. Now we have to tread even more carefully, even when there's a genuine sub-sale arrangement, regardless of whether there's tax avoidance motive. If there is a tax saving as a result of the sub-sale arrangement, then we could be caught by Section 75A. So I put what next. There is also a case, Hanover Leasing, which has recently gone through first tier tribunal, which obviously is not binding, but still instructive, which takes things even further and says that even where there is, say, a tax saving applied, you could still be caught by 75A, even if that wasn't the intention. And just as a result, as a byproduct of what you've done, there is a tax saving as a result, which I think is crazy, and be interested to see whether that is appealed, although I think they may be coming up to the point where they're out of time to appeal that case. Brief mention of capital allowances. Again, I've put a lot of headings on the screen there. I'm not going to have time because we're already up to nearly half an hour, and I want to give Keith opportunity to talk. So I think we've realised we've bitten off a bit more we can chew in this hour today to talk through all of these. But I think people will be hopefully fairly familiar with capital allowances, although they are underused and underutilised and underclaimed. There are maybe some statistics I was looking at on the website, HMRC's website the other day, about the number of people who simply don't claim capital allowances. The thing that I wanted to talk about, actually, and again, I know I've got some bullet points up there, and that's not what I'm going to talk about, is when people are buying properties, making sure they protect the ability to claim capital allowances, so developers. So this can be quite an important point, and something I used to see in practice as a lawyer quite regularly, actually, that if you've got a developer buying property, you really need to understand, or they need to understand, what the capital allowances position is in relation to that property, because there could be some really valuable reliefs to claim via capital allowances in respect to that property. But if those have already been claimed, or if there's an election in place at the point of sale, they may be prevented from claiming those reliefs. And that can be quite a point of negotiation. So although it's slightly more of a legal point, I think it's worth always, when you've got property developer clients, discussing capital allowances with them, clearly making sure they're claiming allowances for plant and machinery and integral features. Things like energy efficient allowances, you've got remediation of contaminated land and all sorts of other capital allowances now. But yeah, make sure that those are being claimed. ATED, brief mention of ATED, annual tax on envelope dwellings. So again, we talked about the fact that most of these properties that property developers acquire are likely to be held through a company. If they are, they may well be caught by ATED. And the ATED applies to residential property worth 500,000 or more held by a corporate entity or a non-natural person, but in this case, a corporate entity. There is, I should say, an exemption for properties held and used solely for property development activities. So that's good news. And there are also various reliefs for things like property trading and property developer relief. And I'm just going to refer to my notes here just to make sure that I'm telling you correctly what this says. So again, I mean, it's fairly obvious what a property development is, but a property development means a trade that consists of or includes buying and developing for resale residential or non-residential property, and is run on a commercial basis with a view to profit. So the good news is that if it's caught by ATED, there's likely to be a relief for property developers. However, the bad news is that they are still required to submit an ATED return, regardless of whether relief's paid. I'll put that and pay tax, but clearly if there's a relief, they won't be paying any tax by 30th of April. But returns are still required to be submitted, and this is often overlooked, we find, by clients, that they think, well, I've got a relief, or they're either aware of ATED or they're not aware of it. If they're aware of it, they think there's a relief that applies and therefore don't always submit returns, but they do need to submit those returns regardless of whether there is tax to pay or not. A couple more slides from me, I think, and then on to Keith. This might be the last one, actually. Construction industry scheme then. Again, worth mentioning, construction industry scheme. I said brief mention on the synopsis. It is a brief mention. Again, the conditions are on the slide, or some of the conditions are on the slide. I mean, this applies to, I would say, large business, but the way that everything's going and prices are going, maybe not. So if a business spends an average of £1 million or more per year on construction work over a 3-year period, then they will be required to register for the construction industry scheme. So that's those constructors who are paying subcontractors for the construction work, essentially. So again, it's quite a high threshold, but with everything going the way it's going, may not be such a high threshold to meet for many developers these days. So let's assume the developer is the contractor. They are employing subcontractors to carry out construction work. They have some obligations, which is to verify their employment status, and then they must deduct a tax source from those subcontractors and submit monthly returns. Again, we find that maybe you don't, but we find that many developers are not fully aware of the construction industry scheme, or if they are, they don't operate it correctly. So just worth being aware of that. So you can have that discussion with clients and make sure they are fully aware. And I think that brings me to a conclusion. Let's have a look. Oh no, sorry, one more slide. I was getting ahead of myself. Capital gains tax and reporting requirements, and then I think that is me then. So I mentioned earlier distinction between UK residents and non-UK residents. Again, everyone will know what capital gains tax is and how it works, and we've got higher rates applying of 18 and 28% for residential property gains. So UK residents are now required to report disposals of a residential property using CGT on UK property form, PPD, CGT, and pay the estimated CGT within 60 days of the completion of the sale. That number has kept changing. It was 60 originally, I think, and then it changed to 30, and now we're back to 60 again. That can be completed online, or it is available to download as paper copy, but only for certain categories of seller, like personal representatives and corporate trustees. Non-UK residents, though, they've got similar treatment, but broader applications. So must report disposal of any UK land and property, again, within 60 days, and these property-rich entities in particular, but they must report those whether or not a gain is made. So a bit like with the sort of ATED returns and things, it doesn't matter whether it's actually in tax, they've still got to report those disposals. And again, just to say that obviously usual deductions and reliefs apply on capital gains, so your annual exempt amount, costs of buying and selling the property, your stamp duty, land tax, business asset disposal relief if relevant, and investors relief, which is not something I'm going to cover today. And then we are over to Keith, I think. So I'm going to just turn the camera slightly. Camera. And then Keith will talk to you about that. Thank you very much.
Okay, thank you, Angela. Good morning, everybody. What I'm going to do over the next 20-25 minutes or so is just give you an overview of the main areas, main issues, main opportunities that we come across when helping our developer clients on VAT. So I'll start off just with an overview of the VAT treatment of land and property. Again, a lot of what I'm going to talk about, or some of what I'm going to talk about, at least you'll probably be aware of, some more than others though. So I'm going to just give a brief overview just in case you're not wholly aware of the basic principles around land and property VAT. So, as we know, I'm sure everyone sees VAT and property transactions as a relatively complex area of VAT. But in principle, a right over land is VAT exempt. So that's the starting point for everything. And this applies to both residential and commercial property, and also to land and buildings. So when we talk about property, we're talking about land and buildings. There are separate rules that apply to land and buildings in certain circumstances. But in general, most of the rules that we talk about apply to both land and buildings, and residential and commercial, unless there's an exception. But of course, this is VAT. So even though that's the basic principle, there are a number of exceptions to this basic rule, but many more probably exceptions than they are the rule. So we're going to start looking at residential property. So, for example, one of the exceptions to this basic rule is the VAT zero rate. Applies to some residential property transactions. So one that we're probably aware of is the VAT zero rate applies to the first grant of a major interest in certain residential properties. And what we mean by this, I mean, this is, I've taken those specific terms from the VAT legislation, because we have to be precise when we're looking at how we apply the VAT, how we apply VAT to transactions. So what we mean here is a major interest is either the freehold sale or a long lease over 21 years, or in the law is slightly different in Scotland, and a long lease for VAT purposes is a lease that's over 20 years in Scotland, but elsewhere in the UK it's over 21 years. So if the transaction is a freehold sale or long lease, that's a major interest for VAT purposes. And the first grant, it means what it means. It's simply the first time any major interest has been granted in relation to that particular land or buildings. So we have to be really precise when we're looking at what the conditions here. Okay, so to give you some examples, the VAT zero rate applies to the first grant of a major interest in a new dwelling. So I think that's one of the areas that most people are aware of. Like if you build a new house or a new apartment block, the first grant of that. So if you sell a freehold or a long lease in the house or the apartments, then that's going to be zero rated. Okay. Now, so moving on to other areas where there's zero rating that you may not be quite so aware of. So a residential conversion, what we mean by that is where you take a non-residential building and convert it into a dwelling or a relevant residential building. So what we mean by, I think we understand what a dwelling is, and as Angela mentioned dwellings before when she was talking, there's a definition in the law about what a dwelling is, and that's the same in VAT. And one thing to bear in mind, actually, it's worth noting that Angela's talked about a lot of tax areas, and I'm talking about VAT, and some of the terms that we use are similar, obviously because we're talking about similar transactions quite often. But the definition from a VAT perspective is quite often different to the definition from other for the purpose of other taxes. So I think that it's worth just bearing that in mind as an aside. That you're just going to be very careful what we mean by a dwelling. There's a very distinct definition in the VAT legislation what a dwelling is, but in simple terms, it's a new flat or a new house or relevant residential building, which is similar, but something like a care home. So it's not, a dwelling where individuals or families are going to be living. It's somewhere where a group of people are going to be living. So it's like a care home or student accommodation and the like. There are similar but separate rules for those types of building, but they can be zero rated when they've been developed. And I put on a 10-year, a little asterisk there saying also the 10-year rule. This is an interesting one that I find not many people are aware of. So when we're talking about converting a non-residential building into a residential building, the VAT law allows an old residential building to be classed as non-residential, but only if it's not been occupied for residential purposes for 10 years. So Angela before talked about derelict properties from a tax perspective, and this is a sort of a similar thing really from a VAT perspective. But again, it doesn't matter here. This is a good example of how things are different, because it doesn't matter what condition it's in. All that matters is that it's not been used for residential purposes for 10 years. It might be pristine condition for all we know, but it doesn't really matter. It's just the time since it's last been used. So essentially, if it's not been used for 10 years for residential, it's classed as non-resi from that perspective. Okay. Relevant residential, I mentioned before, an example of that is like a new care home. And relevant charitable building, this is an interesting one. It crops up now and again, and this is really tricky from a VAT perspective, because a relevant charitable building is a building that's built for a charity, but that's not enough. It has to be used only for non-business charitable activity. So this is quite a rare thing, to be honest, but we do see it now and again. This is a real specialist area, and there are VAT advisors who do only this. I know some who do nothing but look at charity VAT because of its complexity, and so a lot of activities of charities. Again, I don't want to sort of go digress too much on this, but again, as a general point, if you come across charities VAT issues, a lot of people think there are VAT reliefs for charities, full stop. If you're a charity, you don't pay VAT. If you're a charity, there's no VAT on your income, this, that, and the other. That's not the case at all. The charity VAT reliefs are drawn very narrowly, and they're only specific, but they're only available under specific circumstances. And this is a good example. So if you're building a new building for a charity, you can only zero rate that if it's used for very specific non-business purposes. And a lot of charities have a lot of business activity, taxable activity on which they pay VAT, and they're not eligible under this rule. So that's an interesting one that crops up now and again. Okay. VAT liability construction services. So we've looked at the liability so far of sale and lease of those of these buildings, residential buildings. But let's look now at the construction costs. So again, there's a default position for these things, and as always, there are more. Well, probably not more exceptions, but there are lots of exceptions to the general rule. But the general rule is construction services subject to VAT at the standard rate, which is obviously 20% at the moment. But there are a number of zero-rated examples. So construction of new dwellings. So if you're in the process of building a new house or block of flats, the services you provide in constructing that building will be zero-rated for VAT purposes. Likewise, if you're building a new residential or charitable building, the similar buildings we were just talking about before in terms of the zero rate of the sale or lease, the same applies to the construction costs in building those. Excuse me. Ones we see just as often nowadays are construction services that are subject to the reduced rate of VAT, which is currently 5%. An interesting point I'll just mention, actually, I'll go back when we look at reduced rate of VAT. Again, it's the important point to look at. This may change because now we've left the EU. The UK government and Revenue and Customs have got very wide powers now in terms of what they do with VAT, because as a member of the EU, we were bound by the EU VAT laws, which we're not anymore. And the reason the reduced rate of VAT is 5% was that's the minimum amount of the minimum rate we could apply as a member of the EU. So this is why we see a lot of reduced rates at 5%, because that's the minimum we could go to. So this could be decreased or increased indeed in future, but at the moment it's 5%. So it applies to the conversion of non-residential properties into dwellings. I mentioned before those types of transactions. So the costs incurred in relation to those, rather than being at 20%, are at 5%. And this is an interesting one as well, is that where you convert or renovate a building. It can be an existing residential. It doesn't have to be non-residential, and the conversion or renovation involves a change in the number of dwellings. Then the work carried out is subject to 5% VAT, not 20% VAT. Now, we did an interesting piece of work recently for a project in Battersea in London, where the client had acquired a block of flats, an old block of flats, and they were converting them, obviously modernising them and converting them. But while they were doing that, they changed the footprint of the block of flats, and it involved changing the number of dwellings. So normally that work would have been subject to 20% VAT, because it's just, you know, it had been occupied recently, so you know none of the other rules applied. But because to change the number of dwellings, we advised them on how their contractor could apply 5% VAT rather than 20% VAT, and that saved them a significant amount of VAT. So it's always worth looking at that when you've got that type of project. Another interesting one is a renovation of a residential property that's been empty for more than 2 years. I mentioned before the 10-year rule. So if you've got a residential property that's not been used for 10 years, it's classed essentially as non-residential for VAT purposes. This rule is more common. We see this quite a lot because obviously 10 years is quite a stretch. There aren't that many properties that haven't been occupied for 10 years, I guess, but there are a lot more that haven't been occupied for 2 years. So if you buy an old residential property, if you can show that it hasn't been occupied for 2 years for residential purposes, all the work in renovating that property will be subject to 5% VAT rather than 20. So again, that's a massive VAT saving for quite a common situation. And again, this is something we advise on regularly because it's something that people are not necessarily aware of. Certainly contractors as well. If as a developer, you're relying on the contractor to understand the VAT rules as well as yourself. And a lot of the work another aside from me, I guess here is that a lot of the work we do is liaising between developers and the contractors to get the contractor comfortable. If we're saying there should be a VAT relief available for the construction work, we get involved in sort of negotiating and liaising between the two parties to get them comfortable that they should charge 5% or zero rate, whatever it might be, rather than charging 20%, because obviously they want to make sure that they're doing the right thing. They don't want to be charging 5% when they should be charging 20%. So we can show the reasons why the relief applies, and that's what we do a lot for our developer clients. Okay, so that's residential property. So again, I should have said it at the start really of the residential property. What I hear quite a lot from clients and accountants and colleagues, indeed, not necessarily my current colleagues, but colleagues in the past, is that if you've got residential property, that's not really that important. It doesn't really apply to residential, it's all exempt. But as you've seen from the last few minutes talking, all of that, all I was talking about over the last 5-10 minutes was residential properties really. And you know, from that you can see there are a lot of areas to look at. So we're sort of moving on to commercial property now, which is the area that most people think that applies to. And of course it does, but not just commercial property. So let's have a look. Again, the default position for property transaction is exempt, but there are lots of exceptions, but certainly with commercial property. So standard rate VAT applies to the freehold sale of new commercial buildings. And the 3-year rule I've put in brackets there. What I mean by that is in the VAT legislation, a commercial building, i.e. I put commercial, what I mean is non-residential. So it could be any type of non-residential building. If it's new, with while it's under construction and within 3 years of it being completed, any freehold sale of it will be subject to VAT automatically. So that's quite, from my experience, that's a part of the VAT law that not many developers are aware of. So that's worth looking out for. And there are other exceptions. I'm just going to list a couple here. The right to park a vehicle, including the lease of car parks. So parking is automatically, even though it's a right over land, arguably, which should be in principle exempt, the VAT law says specifically it's subject to VAT at 20%. And I put including the lease of car parks because I'm doing a job at the moment where we've got a client who's leased a car park to a third party for a number of years, not realising that it was automatically VATable. And they've been treating it as exempt from VAT. And in their particular case, it's not created a problem because they weren't VAT registered. But what we're doing at the moment is retrospectively registering them for VAT. Go back 4 years, and then they're managing the situation by they'll be charging VAT to their third party retrospectively, who are fine taking the VAT charge because they can recover it, but our client can recover VAT costs by registering that they weren't previously able to do. So, you know, there's lots of little nuances to commercial property VAT that are worth knowing about. Fishing rights, the right to take game, for example, again, arguably a right over land, but the VAT law says subject to VAT. And the last one on my list here, there are a number of others in the VAT legislation that say there are exceptions to the general rule, but they're just some examples. But the main one here at the bottom is what most people are aware of, is a supply that's subject to an option to tax. So we'll just look at the option to tax in a little bit more detail now. So what the option to tax is simply really choosing to charge VAT in relation to a commercial non-residential property transaction where it would otherwise be VAT exempt. And the reason for doing that is to recover VAT on related costs. So you might ask yourself, why would you choose to charge VAT on a transaction? And that's what it's all about. This is exactly what the option tax is all about, is to enable VAT recovery. So going back to basic principles, if your land transaction was exempt from VAT, any VAT costs you incur in relation to that transaction would be irrecoverable. So simply by choosing to charge VAT, you have to charge VAT on the transaction, but it enables you to recover all of that on your costs. And that's exactly what the option tax is all about. An option tax can be made by anybody in relation to any property. However, it will only have effect in relation to supplies made by the person who makes the option. So this is an only in relation to that particular property. And this is a misconception that I hear all the time, because one taxpayer has opted to tax a particular property. I've heard it said many times that property is then taxed, has been opted, and it will thereafter be VATable. Even if it's sold to somebody else, it'll be subject to an option to tax. That's not the case. The new owner will have to make their own separate decision whether to opt to tax that building. So the option doesn't pass with the building. It's only relevant to the person who makes it, and in relation to the property they make it in relation to. So that's something that's really important to remember. The other thing is it can be revoked, but only within. It can be revoked at the start within 6 months, which we call the cooling off period, and that's only if it hasn't taken effect as well. So if somebody opts to tax a property and they change their mind within the first 6 months of before the expiry of 6 months, they can revoke that. They can change their mind, but only if they've not made a transaction or recovered any VAT in relation to that property. And the other one that we're seeing more of now is you can revoke an option to tax after it's been in place for 20 years. There are some quite complicated rules about revoking option to tax, so it's worth looking at very carefully. But the trigger is 20 years, so it's only relatively recently that revocations have been available. We've dealt with quite a few recently, but the rules are quite complex. But it's worth being aware that can happen. So when an option to tax is made in relation to property, like I said, what that does is notify Revenue and Customs and that you've chosen to apply VAT where VAT would not normally be applied. But there are certain circumstances where it will not apply. Even if you've made an option to tax in relation to a building, it will not apply because the law does not allow it. So a building designed or adapted as a dwelling can never be subject to VAT. So you can opt to tax a block of flats if you want, but it will not be effective because the law does not allow it. Okay. a building to be converted into a dwelling or relevant residential building. So if you own a pub, this is one we see all the time. If you own a pub and you're selling it to a developer, you own a pub and you opt to tax the pub and you sell it to a developer, the developer can issue a certificate to say, I'm going to convert this into dwellings, therefore you cannot charge me VAT. And the law, that's what the law says. So that's a really important one to be aware of as well. Building to be used for charitable purpose by charity for a non-business purpose, you can't charge VAT, even if you're opted. A land supplied to housing association, you tend to build dwellings on it. Again, you can't charge VAT. Land supplied to an individual who intends to build a dwelling for their own occupation. So if someone's doing a DIY house build for themselves, they buy a plot of land. If that plot of land is subject to VAT because it's opted, it will not apply. You can't charge VAT to an individual who's going to build a house on land. That's one that, again, not many people are aware of. Okay. You can see we're getting quite close to the close, so I've not got much more to talk about, but what I will do is just talk about, excuse me, I missed one. One of the most important parts actually, where an options tax will not apply is there's an anti-avoidance measure, where if it's a transaction between connected parties, and the occupant uses the property otherwise than for wholly taxable purposes, then the VAT legislation says that the option to tax made will not apply. So it's an anti-avoidance measure to stop exempt businesses developing a property in one company and leasing it to the exempt business, opting to tax, recovering all of that on its construction, for example, and leasing it to its exempt subsidiary over a period of years. What initially happened, what caused this to happen was Canary Wharf. This is specifically a defence against world development at Canary Wharf in the 80s, because what the banks were doing were building the properties in one company, recovering all of that, opting to tax, charging VAT to the banks, and then collapsing the lease after a year. And that enabled them to recover all of that on the construction without being any cost ultimately, or small cost to the occupants. And Angela mentioned when she was talking about her, some of the anti-avoidance measures, there has to be purpose, and there has to be, it only applies if there's mischief. This rule applies if the conditions are met, whatever the intention behind it. So it's an anti-avoidance measure that gets applied to lots of innocent transactions when there's connected parties and exempt businesses occupying properties. Pension schemes, we see it a lot applying to pension schemes. So where you've got a business and the owners set up a pension scheme to buy their offices or their trading premises to lease to the business. That's quite a common situation where we see this kicking in inadvertently. So it's one to look out for when you've got connected party transactions like that. Okay, so I'll quickly look at an important part of property development is the capital goods scheme and VAT recovery. VAT recovery rules that apply to land and property are the same that apply to any transaction. You can only recover VAT to the extent that costs are attributable to taxable activities. However, there are special rules for land and property where the land and property asset, in inverted commas, costs £250,000 or more, excluding VAT, and the cost was subject to VAT. These are what we call capital goods scheme items. Typical examples: acquisitions of land and property, extensions, refurbishments, refits, etc. If the value is 250,000, it's under the capital goods scheme. And this was set in the late 80s. They've not changed the value at all. So 250,000 was a significant figure then, not so much now. So there are lots of transactions that are caught within this now. So it's worth knowing about. So initially you recover the VAT under the normal rules, but every year for a 10-year period, you have to look at the use of that building. And if it changes at any time in that 10-year, there may have to be an adjustment to the VAT that was originally recovered. So that's the essence of it. So it's really important to understand that that applies to any land and transaction over £250,000 where VAT was charged. So that's something to be mindful of. Finally, I've got a couple of slides about the construction industry reverse charge. That's something that came in a couple of years ago. To be worth being aware of. And it applies to subcontractors where their services are subject to VAT and they're subject to the construction industry scheme that Angela mentioned before. And they're supplied to a contractor who will use those services to make an onward supply. So services to the end user don't come under the reverse charge. And the way it works essentially is it's an anti-avoidance measure that was brought in because a lot of subcontractors were charging VAT, not declaring the VAT and basically running off with the VAT, or the compliance being generally poor under some subcontractors. So revenue customers wanted to switch the liability from the subcontractors to the main contractors. So the subcontractor doesn't charge VAT, but the client self-charge VAT at 20% on the receipt of the subcontractor's invoice, and then they treat that self-charge VAT effectively the same way as though it was charged on an invoice, so they can recover it if it's recoverable and restrict it under the normal rules otherwise. So that's just something again to be aware of. The rules are, I made it sound quite straightforward there. It's not quite as straightforward because it's VAT obviously, but yeah, that's in a nutshell how that scheme works. So it's worth knowing about. And I think that's me done. So thank you.
Thank you, Keith. So swing this back my way. Obviously, people that know me know that I was up to the last word. I've just realised there's one point I forgot to mention the construction industry scheme, just because it's what Keith just talked about there, is that I went on about £1 million, but if someone is registered for that, already a property developer, then they are obliged to register for the construction industry scheme regardless of their spend on construction services. So just something to mention there that I've forgotten about, which links into your point, Keith. We have us both on camera, we'll try. So thank you very much, everybody. That is the end. I know that was a very quick run through of all things property developer tax. It's, you know, so we realised at the start that yesterday, didn't we, as well, that we thought we probably bitten off quite a lot in that hour-long session. But if you have got questions, please do put those in the Q&A or send us those afterwards. I'll flash up an email address in a minute. Just a quick note of our upcoming webinars, next couple that we've got. So we've got Should We Go Nuts for QNUPs, which is on the 14th of September. And then we're following with that with tax disclosures, what you need to know, on the 26th of October. So hopefully some of you will want to sign up for one of those or both, ideally. And then gone back. Thank you. So that was the end. And I say any questions, we'll download those from the Q&A if you put them in there. And then if you've got any other questions that you think of afterwards, please just email comms@etctax.co.uk. Thank you very much, folks. And that is the end. Have a good rest of your day.
Thank you.
Thank you.